Hello friends, welcome to Sundaram Mutual Fund's monthly debt market update. The month of April started on a positive note with RBI Monetary Policy Committee delivering a status quo on the policy rates vis-a-vis the market expectation of a rate hike of 25 basis points. MPC clarified that the committee has taken a pause to assess the impact of the actions taken so far and market conditions, and this is not a pivot into the policy stance. However, it was followed up by easier liquidity conditions, softer global bond yields, and benign prints on inflation, both domestically as well as globally. This led to sharp rally in the yields across the curve. On the macroeconomic front, the CPI inflation for the March came at 5.7%, that is below the RBI upper band of tolerance for inflation. And with the expectation of next print, that is the April print to be released in May, is also expected to be closer to 5%. We believe that RBI has raised the bar for any future rate hikes with delivering a pause on the back of two back-to-back 6% plus inflation prints. And now it is expected that the RBI will continue with the pause in the next few meetings as well. With this, we believe that the global backdrop on macroeconomic stability is improving. The inflation for FY23 averaged around 6.7%, whereas the inflation for FY24 is expected to fall to 5.3 to 5.5%. Similarly, the current account deficit, which was a few months back expected to be 3% plus for the FY23, is now expected to be in the range of 2.2 to 2.4% on the back of phenomenal services export and reducing crude export due to fall in crude prices. Similarly, the fiscal deficit is also expected to improve to 5.9% from 6.4% in the FY23. On the other hand, the economic growth is expected to fall to anywhere between 6 to 6.5% by most market economists compared to 7% in FY23. Globally also, inflation has fallen from close to double-digit prints to 5 to 6% band, and majority of the advanced economy central banks have either reached or are closer to the end of their rate hiking cycle. We believe that with the recent action on the rates globally by the central banks will lead to softer economic growth, and with this improving trend on inflation will nudge the central banks to shift their focus on supporting economic growth vis-a-vis fighting inflation, which we have seen so far. This bodes well for the fixed income investments, and given the current high rates and the flatter interest rate curve, we believe that the opportunities in short to mid duration of the curve are better suited vis-a-vis the long end of the curve, as long end of the curve can remain sticky on the back of supply overhang and uncertainty over the quantum of rate cuts. We believe that the investor should increase their fixed income allocation and also increase the duration of their fixed income portfolio. Accordingly, investors with 12 months plus kind of an investment horizon can look to invest in short to mid duration products like corporate bond fund, banking and PSU debt fund, and short-term bond fund. Similarly, investors with 3 to 12 month kind of investment horizon can look for products like low duration money market fund. Investors with shorter time horizon can look for ultra short duration. Savvy investors with relatively longer term investment horizon who can time the market can also look to invest in long-term bond funds. However, for most investors, opportunities in short to mid duration would be better suited. With this, we'll wrap this update. update. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.